G'day Alpha. So why can't we just buy assets under a company and pay the 25% flat tax rate instead of creating a trust? This is a really good question. Now what we need to understand is that the 25% taxation rate in a company is for a trading company that typically produces under $50 million in revenue. And trading means that it produces active income by way of running a business. So if it is purely for investment purposes, it doesn't have a 25% tax rate. It actually has a 30% tax rate. Now, we need to understand that there are some fundamental differences between a company and a trust. There are pros and cons, and that allows us to make informed and educated decisions around the types of activity that we do in either of those structures. So let's run through it at a pretty high level. So a company for investment purposes has 30% tax rate on income and capital gains. It doesn't have a capital gains discount. It pays flat 30% tax on all of it. And the benefit of a company is that it does not need to distribute its profits each and every single year. It can accumulate those profits and it can decide when it pushes out those profits to beneficiaries. The other benefit is that a company has what is referred to as franking credits, which means that for the tax that is paid on that corporate tax rate, so in this case 30%, it receives a credit for those that it then passes on to the beneficiaries, and we can utilize those franking credits in order to take advantage of discrepancies in terms of tax rate over time. I'm going to circle back to that in a moment. Now, on the flip side, a family trust does not pay tax. It essentially is a pass-through entity. And essentially, it has the same taxation rules as an individual. So it has discretion over who it distributes to. It is the individual that it distributes to who ends up paying the tax at their marginal tax rate. However, the income is taxed at the marginal tax rate, but capital gains also has access to the capital gains discount if the asset has been held for more than 12 months, meaning that the capital gain can be reduced by 50% by way of that CGT discount. And then essentially that then passes through to the individual and they pay tax. The downside is that a family trust must distribute all of its income every single year. And this is where the company comes into play. So for many of our clients who earn significantly high incomes, typically they've got in the vicinity of $300,000 or $400,000 at least running through their family trust every year, that we can use what's called a bucket company. And essentially that bucket company is a corporate beneficiary for the family trust. So we could distribute to, let's call it Bob as an individual, or we can distribute to Mary as an individual. But if those two individuals are receiving more than $200,000 a year in income by way of personal income or distributions, they're paying an average of 30% tax. So at that point, anything above and beyond that, we can choose to distribute that to a bucket company, which is only paying 30% tax. So anything there onwards, it's going to make sure that they don't pay any more than 30% tax on average. And what we do is in that bucket company, we accumulate that cash, we invest it. Usually we buy shares, but in some cases we do also buy property. And it's usually property that we have no intention to sell for the foreseeable future. And what we do is we accumulate those franking credits, which essentially sit there on the balance sheet until such a time as the distributions take place. Now, what typically ends up happening is that Bob and Mary go through their life, they run their business, they get to retirement age, we've hopefully contributed as much money as we possibly can to superannuation, we've sold their business and we've got access to the small business CGT concessions, and they've got to a point whereby their income is drastically reduced in terms of personal income because their business is gone. The vast majority of their income is tax-free because it's in pension phase from their superannuation. And then we can now start distributing surplus if they need it from the bucket company. And because their individual tax rates are less than 30%, they receive a refund for that tax that they've already paid by way of those franking credits. So it essentially means that we're paying tax, yes. However, we're also creating a credit that can potentially be refunded to those individuals at some point in the future when we implement the right tax strategy. So this just goes to show that when we implement tax strategy and tax structures, we very rarely just implement one structure. We want to make sure that we implement a number of structures that when used together in a sequence and when implemented with the right strategy to support it, that we can actually make sure that we can get a significant advantage by optimizing the current tax position or providing an advantage in terms of future tax position once the strategy has been executed and the clients get to retirement phase, like in this example. So this makes sense? Any questions? Let me know in the comments.